In this video, I'm going to explain why I sold out of my Google stock. So, as you guys can see, the portfolio was up 2% in the day, following a very nice performance by Google today, up a little over 5%. As you can see, though, I have 0 shares because I sold it. I had an average cost of $86.81. Google rallied all the way up to past $98 at intraday high. It actually, I sold it for $96.80. So made almost $1,000 or about $1,000 on that trade. Was sad to let Google go, but didn't want my emotional attachment to the stock to hinder the portfolio's performance. So we cut it due to it simply being a little bit overpriced, in my opinion. Not for the long term, but for the short term. And I understand it's wiser to have a long term mindset when it comes to these types of things. But with earnings coming up, I believe they report February 2nd, if I'm not mistaken. I entered this trade back in late December, and it's been about a month since I've been in the position, and I was up about 12% on the position, and just found that it was a good, the macroeconomic conditions haven't really improved at all. If anything, it's getting worse, and inflation is subsiding, but companies are cutting back more and more on their advertising budget. And obviously 90% of Google's revenue comes from AdSense. So they're obviously not immune to this macroeconomic condition. And I believe that is going to affect their Q4 earnings coming up in early February. Now, in this article that we saw that came out today, which caused Google's stock to surge over 5% today, Alphabet cuts 12,000 jobs after pandemic hiring spree and refocuses on AI. Sounds like a good memo that the CEO put out today, and it was a very nice reaction from Google stock. So I took advantage, in my opinion, of this opportunity and this nice 5% pop that we saw here right before earnings, a few weeks out, to capitalize on some gains and to realize some gains. Personally, I do think this may have been a bit of an overreaction. Yes, it is fantastic that they cut 12,000 jobs, because as we know, one of Google's main problems was their hiring spree that they went on. I believe in one of Joseph Carlson's videos, he goes over that, and it was a bit absurd how much money they were spending on employees and exactly if they were getting the production efficiency from those employees and if it was honestly really needed or not. So good to see that they're cutting jobs and refocusing on AI. It's a good look for the company. But I'll be looking to definitely get back into Google in the $80 range. Maybe somewhere in the $80 range. I'd be looking to start my position in Google again. Right now, if we go to Qualtrim, one of the platforms I really like to use, which is actually Joseph Carlson's platform as well. I like to use this for analyzing companies. It's a nice clean look. Yeah, Google up 5.3% today. Very clean look. Just very easy to navigate and to get quick data efficiently and analyze companies quickly. So I'd be definitely looking to get back into Google. Google's a fantastic company in my opinion. It's just I want to take gains leading up to earnings. Hopefully maybe the market reacts poorly to future guidance that they may give due to macroeconomic conditions that they might be projecting. and I can capitalize on that. But I don't think this is right, to be honest. I've gotten other. I don't think Qualtrimm's right on this one. I believe Google's actually trading at a 20 or near a 20 forward PE ratio right now. And again, guys, I know PE isn't everything, but it is something. It is a metric to look at, and I feel more comfortable adding Google in the high 17s, low 18 PE ratio, which it was at in the $86 range. In the $20 PE ratio range, it just gets a little hairy, especially again a company that is so easily affected by macroeconomic conditions, and you know advertising budgets are directly correlated with economic booms and busts. So if we have a slowdown in the economy, which the Fed has stated over and over again is their goal to slow the economy, advertising is going to be one of the first budgets to cut back on, and Google's going to suffer from that. And we're just seeing the beginning, in my opinion. So I'm going to be very patient adding Google back to the portfolio. Yes, it was a great rally today, and again, capitalizing on the gains. And I'm just going to continue to sit on the sidelines, wait for it to drop down to a price I'm comfortable holding for the long term. And yeah, we'll see where it takes us. Hopefully, Google just doesn't take off without me. I doubt it will, but if it does, so be it. Decision I made, I will live with it. But a stock I did add to the portfolio, you might have saw, was Meta. Yes, not a lot of people are covering this on YouTube. Yes, there are a few, but not a lot. And I've ran the numbers on this many times. Just future. Actually, I'll pull up that as well. I do use Everything Money's stock analyzer tool, which I believe is a fantastic tool. Again, check them out if you want to. But again, I know the stock analyzer tool isn't everything, but first we'll go to 8 pillars because I do like looking at this as well. The 5-year PE ratio is 14.5. In my opinion, that's crazy for a company like Meta. I understand it has all the headwinds ahead of it. Zuckerberg's obsessed with the metaverse, and I really do hope he focuses a little bit more on the bread and butter of Meta's core business, which is advertising and Facebook and Instagram, WhatsApp, all that stuff. I hope he really does taper back on the metaverse. I know hope isn't a good strategy, but I really do feel, especially at the stock's performance that we've seen, that he is going to have to be forced to really take a step back and realize that his heavy investments in the metaverse right now, it's just not a good time. It's not a good time with what kind of macroeconomic conditions we are facing. That he's got to realize that maybe he needs to put the metaverse on pause. And I hope he realizes that and continues to grow free cash flow and focuses on profitability in the company. He's already laid off. He's already done similar things to what Google has done today in laying off several, I believe it was 11,000 employees. So he's doing some things right and he's doing some things wrong. I mean, but I believe the market has discounted this company a little bit too much, and I'm willing to take the bet on the long term that either they turn it around, or either they are successful in the metaverse and it's a huge hit, or they bust on the metaverse and eventually cut it. And as soon as they cut that free cash flow is going right back. That free cash flow is going right back. That the 10 billion, the 10 to 15 billion they're losing annually on the metaverse, that it's going to come back in an instant. If they just say, hey, we failed, this is a bad idea. That's it. That 15 billion is going to go right back into their free cash flow statements and eventually into shareholders' hands, which I really hope they announce a share buyback program, considering the stock is so cheap. And if we go back to Qualtrim here, I mean, their balance sheet is fantastic. It's a fantastic balance sheet they have. Not not as good as Google's. Google's might have the best balance sheet in the entire market. Actually, no, I think I'm certain it does. But Facebook has Meta has a fantastic balance sheet. They're not going under, guys. They're not going under. Not anytime soon, at least. They got $41 billion on cash on hand. Their debt is $24 billion. I mean, guys, they could just write a check, pay off all their debt like that. I mean, they got a margin of 30%. Operating margin is 30%. Profit margin 24%. They have a forward PE right now of 15. I actually do believe this is accurate. And we can go check on Schwab as well. I'm not sure why Google's is not accurate, but believe Qualtrim does have Meta's is correct and accurate. I mean, 7% free cash flow yield. Guys, that's for a company to be trading at a 14.95 PE ratio, forward PE ratio, and having a 7% free cash flow yield. It just doesn't add up, honestly. I feel like there's a disconnect in the market, and our job as investors is to exploit these disconnects and position ourselves with an ample margin of safety and let it ride. I mean, I'm excited to grow this position. We go back to our count. I do have 100 shares of Meta now, and I'm writing a covered call against it. Where's it at here? Right here, $150 call, expiring next week. I wrote it for $25, and yeah, hopefully it generates $25 next week, and we can do that 4 times a week. 4 times a month. That can generate an extra $100 a month to the portfolio, and that would be awesome. But aside from that, I'll make a video explaining that and how that benefits to and how that aids to my strategy in this portfolio in another video. But yeah, guys, if you agree with anything, actually, before we do that, let me go back and run the stock analyzer tool and run a little bit through these 8 pillars again. So another thing I like about this is, guys, this return on invested capital is 17% in the last 5 years. And that's with the hindrance from Reality Labs Metaverse in the last year. That's with that hit counted into it. Their revenue growth, $66 billion in revenue growth in the last 5 years. Now, mind you, as the company gets bigger, it's going to grow less and less. It's harder to grow when you're big. It's just, it's how it works. Let's see here. We got for cash flow growth. Let's go take a look at the income statement here. Let's go to annual. Again, guys, this software is fantastic. Highly recommend it. It's $29 a month. Oh, let me do that. $29 a month. You get all this data. You can't beat it. You really can't. This combined with Qualtrim, I'm paying $39 a month for these 2 awesome platforms. I think it's worth it. Highly recommend it. I mean, guys, look at this revenue growth. 10 years, 4.2 billion to 117 billion. Is that sustainable? No, I don't believe it is. But that's okay. It doesn't have to grow at 37% annually like it did in the last 10 years. It doesn't have to do that, and it's not going to. Last year, it grew 5%, and that's with Reality Labs. All their focus on Reality Labs, and all their losses in that. So we could be very, very conservative, and we're gonna do 10 years of analysis, And I'm going to put 0%. I'm actually going to put 0% just to prove to you guys how undervalued this company is and just to show you the margin of safety I'm going to use. We will do 3% and we'll do 6% revenue growth. Again, remember they did 117 billion. We pull up a calculator and we'll project out how much that will 6% annually in revenue growth for the next 10 years. So to the 10th power, that would take their revenue to 209 billion 10 years from now. Honestly, that's super conservative in my opinion, especially if Metaverse actually hits. Guys, if Metaverse hits, who knows? People were laughing at the iPod and iPhone when that first came out. And I'm not even going to say I'm a fan of Metaverse. I'm not really. Hasn't impressed me yet. But just to show you guys that 10 years from now, if Meta is doing 209 billion, that would be a 6% revenue growth annually for the next 10 years. Meta is currently doing 117 billion. 10 years from now, I could see Meta doing 210 billion. I think that's actually a pretty realistic and reasonable assumption. And again, for a high assumption, I think this is pretty conservative. So we're going to keep that. Now, this is where it gets tricky because we don't know how their profit margins are going to be in these next few years with Reality Labs and their investment. But we also don't know how it's going to work if they actually start becoming profitable on the Reality Labs investment. How is that going to affect their profit margin? How much is it going to increase it? We don't know. So we're just going to, all we have is past data to go off of. In the last 10 years, they did 31% profit margin. But again, I'm going to go lower than that because of their investment in Reality Labs. And I will accelerate it in the high end to factor in Reality Labs kicking in and aiding in the profit margin. So they did 24% last year. We'll go low. We'll do 24%. We'll do 26.5. And then we'll do 29. Still lower than because we just want to be conservative here. And then free cash flow margin, we will do 22. And we'll do 25. And we'll do 28. PE. Right now it's trading at a 14 or about a 15 PE. It's gotten as low as high 9s. I really wish I was paying attention to this company when it was trading in the 80s and 90s. I really should have been on my game there and added some shares, but I didn't. But we will put 12. Let's see. I mean, 12 is ridiculous. But again, it's growing at 0% revenue growth. So we'll do 12. And we'll do 14, 16. Super conservative numbers, in my opinion. Now let's just say you want 10. Let's say the market's going to be rough in these next 10 years. And you just want 10% annual growth. Match the market. Guys, with 0% revenue growth and a 24% profit margin, lowest it's been in 10 years. With a 22% free cash flow margin, again, lowest it's been in the last 10 years. 12 PE, lowest it's been in the last 10 years. And a 10% annual rate of return. You could buy the stock for $113 on a multiple of earnings value or $104 a share and still expect to get 10% on your money for the next 10 years. And for 3%, 167, 157, and for 6%, you can pay $245. This number means you can pay right now $245 if you believe in these numbers and get a 10% annual rate of return. I mean, again, these are very conservative numbers in my opinion. Let's say the high-end numbers come to fruition. 0.1 to the 10th. Guys, it's $635 a share in 10 years is what it's projecting out. Right now we're trading at 139. Again, these are the high assumptions. We don't know what's going to happen in the future. We don't know. Could be worse, could be better. But again, these are just illustrating some future projections so you can get a feel of what these numbers actually do to a stock price. Highly recommend getting this platform. It's great. Also, highly recommend Qualtrim. Super easy to read and look through different companies. But other than that, guys, we will go to a portfolio performance. Show you guys real quick how we have been doing. So my the portfolio right now has gained $2,076 since the start of it, which the start is December 23rd is when I started this account. And we got, see, we're on the max year to date, max, and right now we have it benchmarked against the Dow Jones, the Nasdaq, the S&P, and the Russell 2000. Our portfolio is in the blue. We are up currently 16.65%, and the Russell 2000 is 4.8, and S&P 2.1, and you guys can read. So yes, we are currently beating the market. I'm very happy with that. But we have a long way to go. We have a lot more time in the year, a lot more time to mess up and begin the trail. So we're gonna try to keep on this performance, and yeah, hope you guys enjoyed this video, enjoyed the different perspectives, and let me know if you guys let me know your guys' ideas in the comments below. Thank you.